Hi students, welcome back to my channel. In this session, I'm going to discuss May 2026 RTP relating to CA Inter Advanced Accounting. So let's start with in this session, I will explain the total MCQs and questions we have in the RTPs. Okay, and listen carefully. And before going to the exam, after completion of your entire syllabus, just go through these questions once and some important points, some new questions we have and some important points we have. Okay, and don't skip this one. Okay, and coming to the first one, year one, a company purchased a land from its own funds and started construction on two towers on the land. The company for the construction so borrowed of 60 lakh each for both the tower, and the company is required to pay the interest of 60,000 annually for each loan. During the first year, company allotted the vacant area for parking purposes, and once which fetched a revenue of 15,000 in year one only. And here, this vacant the amount temporary income received. So shall we reduce it from borrowing cost or not? Means if any temporary income received out of the temporary investment, out of the specific borrowing, then we can reduce it from borrowing cost. But here the parking income received so is not out of the investment, and that is made out of the renting of the vacant land. So this is not relating to the borrowing of the funds, and this is a transfer to the profit and loss account only. Okay. And tower one got ready at the year end of the year two. The company capitalized the same and started using the same for intended purposes. And we have the two towers and borrowing of the funds 60 lakh each, and interest for the first year 60,000, and second year 60,000, and third year also what 60,000. 60,000. But here one tower, so which tower? Tower 1 got ready at the end of the second year. At the end of the second year, it was ready. So then coming to the questions. How much borrowing cost should be charged to profit and loss account at the end of the year 1? In case of the year 1, both towers are under the construction. And the towers are covered under the qualifying asset as per AS60. So these two amount should be capitalized. So 1,20,000 should be capitalized. Then how much amount transferred to P&L? The answer is zero. No amount we transferred to P&L as a borrowing cost because entire amount has been capitalized. And how much borrowing cost is eligible for capitalization at the end of the year one? As we discussed, for tower 160, for tower 260, total 1,20,000. And how much borrowing cost should be charged to profit and loss account at the year end 3? At the year end 3. In case of third year, for tower 1 60,000 is there, and for tower 2 60,000 is there. And tower 1 came into the operation at the end of second year. So for the third year, tower 1 related borrowing cost will be transferred to P&L, and this is only capitalized. So this is transferred to what? P&L. So answer is what? 60,000. And how much borrowing cost is eligible for capitalization at the end of the year 3? So nothing but what? 60,000 relating to tower 2. Okay. Next. So this is the coming to the second question, and this is important one and relating to the AS 90 leases. And Suraj Limited, the lessee acquires machinery on lease from Chand Limited, the lessor, on 1st April 2025 for 3 years. The economic life of the machine is 3 years. Fair value of the machinery is 2,50,000 and the guaranteed residual value is 2,000. As per the lease agreement, the lessee is required to pay 1 lakh per year from the April 1, 2025, and the lessor has a guaranteed residual value of 20,000. However, lessor estimates that it would have value of 5,000 only after 3 years. At what value machinery should be recognized? And here, and this is what finance is. In case of finance lease, lessee will recognize the asset at what price? The fair value of the asset or the present value of minimum lease payment from the standpoint of your lessee, whichever is less. Here we have the fair value of an asset around 2,50,000 we have. But the present value of minimum lease payment was not given. You have to calculate. For calculation of the present value of the minimum lease payment, we need a borrowing rate. But the borrowing rate is also not given in the problem. First, you have to calculate the borrowing rate, and by using the trial and error method. So, and how to calculate that borrowing rate. And here I have the calculation. And here fair value of the asset here is nothing but what? So present value of fair value of the asset is equal to present value of minimum lease payment, present value of plus present value of unguaranteed residual value. But here the always remember the borrowing cost should be calculated only from the point of view of lessor, not from the point of view of lessee. So present value of minimum lease payment should be considered from the point of view of lessor while calculating the borrowing rate. Okay. So here every year lease rentals are how much? 1 lakh, 1 lakh, 1 lakh. And what is the guaranteed residual value in relation to the lessor? In case of lessor, the guaranteed residual value is 20,000. So for the third year. So then consider by applying the trial and error method. First we compute what is the present value of MLP. So at 100. So say we consider present value factors at 10%. These are the PV factors. Present value of MLP. So 90,900, 82,600, 90,100. We have this one. And unguaranteed residual value is not given. So that is nothing but 0. So it should be the total is equal to what? Fair value. Fair value of an asset 2 lakh 50. What is the difference? 1 lakh 36,200. Sorry, 13,620. In financial management, we call this one as what? NPV. NPV. And then, so borrowing rate is nothing but what? The rate at which the present value of fair value of an asset is equal to present value of minimum lease payment and the present value of unguaranteed residual value. So here we have the positive figure and calculate. We have to decrease that one. For decreasing the NPV, so you have to increase the discount rate. And we consider present value factor at 15%. And these are the rates we have. And present value of MLP we computed. Then NPV we have is 8,440 negative. And in between 10% and 15%, our required rate we have. And by using the interpolation and by applying this one, by IRR technique, we compute what is the borrowing rate. Borrowing rate. So here low rate plus NPV at low rate by NPV at low rate minus, sorry, low rate plus NPV at low rate by NPV at low rate minus NPV at high rate into high rate minus low rate. Then if you apply, we get 13.09% approximately. Okay. Then so coming to the present value of minimum lease payment from the standpoint of view of lessee. So here 1 lakh, 1 lakh, 1 lakh plus 20,000 is the guarantee residual value. So 2,000. And in the calculation and while calculating the borrowing rate, here guarantee residual value we consider 20,000, but here we consider 2,000. So remember, while calculating the borrowing rate, guarantee residual value we have to consider from the point of view of lessor. But in case of calculating present value of minimum lease payment for the accounting of an asset, we have to consider its standpoint of view of lessee. So here lessee related guarantee residual value 2,000 only. Then present value factor at borrowing rate we have 2,37,082. 2,37,082. Then asset is recognized. So present value 2,37,082. Asset is recognized at what price? Least of fair value of an asset, present value of minimum lease payment. Nothing but 2,37,082 approximately. Then what is the nearby answer is 2,37,400 approximately. And here we consider three decimals, and if you consider four decimals you will have the another. So approximate figure we have. So answer is 2,37,400. Okay. So this is important one. In this case present value of first borrowing rate was not given, so we need to calculate the borrowing rate by applying the IRR formula and by using the trial and error technique. Okay. So after that we compute what is the present value of minimum lease payment. And while calculating the borrowing rate, you have to consider it from the point of view of lessor. And while calculating present value of minimum lease payment, you need to calculate it from the point of view of lessee. Okay. Next. And third one. Which of the following is not an example of cash and cash equivalent balances held by the entity that are not available for use? So which is not a example for cash and cash equivalent. So first, balance in unpaid dividend account. And this is a specific account and a specific account, but we can use it for payment of the dividend immediately. So this is treated as what cash and cash equivalent. But balance in bank account as a fixed deposit. Say, for example, you made a deposit. You deposit the amount in FD account for say 1 year. Can you withdraw the amount and use it for any purpose? No. So this depending upon the period. The fix in case of fixed deposit, if the tenure is less than or equal to 3 months, then that may be the cash and cash equivalent. Otherwise, it is not a cash and cash equivalent. Tenure is not specified. Then based on the another options, we will decide. Earmarked bank balance for specific purposes. So here it is also meant for specific purpose, but for that purpose we can use it as and when we require. So it is also treated as cash and cash equivalent. Balance in bank account subjected to the legal restrictions. Some legal restrictions are there. So and if our money was blocked, but that amount is used for the corresponding purpose. So as and when we require. So it is also treated as what cash and cash equivalent. So based on this, the better option, which is not a cash and cash equivalent, is balance in bank account as a FD. And here we consider FD is meant for more than 3 months. So it is not a cash and cash equivalent item. Following is an example of research activities as per AS26, which is recognized as an expense which it is incurred. We have to find what research. And the design, construction, and testing of pre-production or pre-use prototypes and models. And this is relating to what development activity. We are in the what construction process and also testing and the search for alternative for material and devices, products, process, systems or so. We are doing the what searching of an alternative for material. We didn't start the construction, so we are researching nothing but what this is under the research phase. This is under what research phase. The design of tools, jigs, molds, dies involving in new technology. So this is also forming part of the what construction activities for development phase and the design and construction and operation of the pilot plant that is not a scale economically feasible for commercial production. So and nothing but so already plan was completed. So this is also complete considered it as a part of the development phase. And here we need the examples for what research. So option is B. Okay, and next. And one theory question we have. Write a short notes on IASP. Just go through it. And you may have the theory question for 4 to 5 marks in the last question. In the last question. And next. This is the one. Already we have this one in our material. And Giant Limited has entered into a binding agreement with the Tini Limited to buy a custom-made machine of 1 lakh at the end of 24 to 25. Before delivery of the machine, Giant Limited had to change its method of production. The new method will not require machine order and it will be scrapped after delivery. So before the delivery, we change the method of production. So, first of all, already we enter into a binding agreement. We can't withdraw from the respected agreement. So, that obligation has been created to you. So, that must be the amount payable to the TINI Limited should be treated as a liability. Actually, what is the entry when the delivery we have machinery account debited to TINI Limited? But we can't recognize it as a machinery because we didn't use that for production of the goods. No economic benefits will arise by using that asset because we changed the method. So no asset will be recognized. So we have to treat it as a loss. Loss of change in method. Account debited to Tini Limited. How much amount? 1 lakh. And that is a loss we transferred to profit and loss. So profit and loss account debited to loss of change in method. How much? 1 lakh. This is the accounting treatment. For example, here after delivery we change the method. After delivery we change the method. In that case, at the time of delivery we write the entry what? Machinery account debited to Tini Limited 1 lakh. And when the method has been changed, then we write the entry. Loss of change in method account debited to machinery account 1 lakh. Then we write the entry profit and loss account debited to loss of change in method 1. After delivery, if there is a change in method of production, these are the entries we record. But here, the method of change in production we have done before delivery of the machine. So we have to write the entries, these two. Okay, next. So seventh one. Virat Traders and unlisted partnership firms had a turnover of 249.99 crore and borrowing 25.01 crore during the financial year 23-24. So it is a unlisted partnership firm. So nothing but non-corporate entity. So ICAI criteria has been applied. And remember, as per the ICAI criteria, entities classified into two. One is the MSME, another one is a large entity. When it is treated as a MSME, if its borrowings are less than or equal to, sorry, if the borrowings are less than or equal to 250 crore, sorry, when we consider it as a MSME, if the borrowings are less than or equal to the 50 crore, and if its turnover is less than or equal to the 250 crore in previous year, and it is not a subsidiary of any entity covered under large entities, and it is not involved in banking, financial institutes, or insurance company, and whose shares or securities are not traded in any stock exchange, either in India or outside India, or even not in the process of listing. And if these points, any one of the point is covered, that is a large entity. Otherwise, it is a MSME. So here, unlisted partnership firm, the turnover is 249, means what? Less than 250 crore. And borrowing is 20.5.01 crore, nothing but less than 50 crore. And it is not a banking, financial institution, and insurance company. And it is not a subsidiary of any another entity. So all conditions are satisfied. So it is treated as a MSM. It satisfies all conditions relating to the MSM. So we can consider it as a MSM in the current year, 24 to 25. Is it eligible? Yes. But remember, but one more point is that, for example, if the entity is if the entity is a large entity in the previous year, but in the current year it is getting the category of MSME, it is getting the status of MSME, then it can't avail the benefits available to the MSME because it has to be retained in that status of MSME for 2 consecutive years. From the third year onwards, only it can enjoy the benefits relating to the MSME. Okay, so is it a first time it is getting the category of MSME or not? If it is not a, if it is a first time getting the category of MSME, it has to be retained in the MSME category for how many years? 2 years. Okay, so these 2 points are important. Okay, here. So based on this, so here MSM, it meet the all conditions, so it is rated as MSM. Further, so it has been assumed that Virat Traders is not a newly qualified as a MSME in financial 24 to 25 because non-company entities that newly qualified as MSME can avail exemption only after it remains as a MSME for 2 consecutive years. Until that, it is treated as a large entity and all accounting standards have been applied there. Okay, next. Then here is the cash flow statement we have. And following are the summarized balance sheets of Dark Limited as at 31st March 25 and 31st March 24. 2 years balance sheets are given. And equity and liabilities, equity share capital, P&L, debentures, trade payables, unpaid interest on debentures. On one point, provision for tax, property, plant and equipment, goodwill, inventory, trade receivables, cash and cash equivalent and other information. Dividend paid during the year 24-25 3 lakhs. Depreciation charged during the year 24-25 20 lakhs. And fresh debentures were issued on 1st April 2024. So it means at the beginning of the current year, those are issued. You are required to prepare cash flow statement under which method? Indirect method. You have to prepare under indirect method. In case of indirect method, so cash flows from the operations starts with what? PBT. But the PBT was not given directly in the problem. So we have to compute. How to compute the PBT? So first change in the profit. So and change in profit and loss account. How much change is there? 5 lakhs. And next, add preference dividend effect. And clearly stated below, the dividend paid during the year is nothing but what? 3 lakhs. So we have to add what? Preference dividend, 3 lakh, and provision for tax. Here, provision for tax related, open provision for tax account, opening balance 5 and closing balance 8, and no further information was given in the additional information. So, in that case, one basic assumption we have. Last year provision is deemed to be paid in current year. So, 2 cash, and current year provision, the current year amount was deemed to be created in the current year by P&L 8. Okay, so this is important. Only opening and closing balances we have. Then opening balance deemed to be paid in current year. Closing balance was created in the current year. So provision for tax, we have to consider for current year date, nothing but 8. So how much? 60. This is the profit before tax we have. Profit before tax. And we have to add non-cash expenses. And non-cash expenses we have here depreciation. So how much amount? 20 lakhs we have. So 20 lakhs. And along with that, non-operating expenses we have. Non-operating expenses here relating to the debentures we have interest. So on what figure we need to provide the interest? So clearly mentioned, extra debentures 10 lakh was issued at the beginning of the year on 1/4/2024. Those are issued. So on 50 lakh we need to provide the interest. So 50 lakhs into 8%, nothing but 4 lakhs. 50 lakhs into 8%, how much amount? 4 lakhs. Okay, and and that is the one. And one more thing, coming to the assets, there is a decrease in goodwill. There is a decrease in goodwill. How much amount? 2 lakh. Nothing but what? Write off of goodwill. That is also non-cash. How much amount? 2 lakh. So we have to consider this one. So 36, 42. And next, changes in working capital. Working capital changes we have to consider. So inventory. Inventory has been decreased. So decrease in inventory. By how much amount has been decreased? 14 lakhs, right? How much amount? 14 lakhs. So decrease in stock. Decrease in stock. And then nothing but decrease in working capital. And a release of our working capital, that is deemed to be inflow. And there is a increase in trade receivables, means our amount blocked in current assets deemed to be outflow, nothing but what? 2 lakh. And coming to here, and trade payables, how much amount is there? So 82 minus 75, there is a decrease, in trade payable. So how much amount? 7 lakh has been decreased, and that is a deemed to be a decrease in outflow. Decrease in trade payable means we settle the trade payable, we pay the trade payable, deemed to be outflow. Okay, then how much amount? So 42 plus 40 minus 9, so 47 lakh, and minus tax paid, and current year we pay the tax of 5. So cash flows from operating activities, how much amount? 42 lakhs. Okay, so cash flows from operating activities. And next one, cash flows from investing activities. In case of investing activities, so first verify. So we have relating to what? PP. So opening balance 205 and closing balance 255, and the depreciation he provided is how much amount? 20 lakhs. So 255 plus 20 minus 205, how much amount? 70. So nothing but purchase of PP we have to consider. How much? 70. purchase of PPE we have to consider. So, okay, 70. Next, cash flows from financing activity. So, in case of financing activity, we need to consider dividend paid. How much amount of dividend paid during the year? 3 lakh. And interest paid. Actually, what is the interest for the current year? 4 lakhs. Interest for the current year is how 4 lakhs. But remember, there is a unpaid interest on debentures. Out of the total 4 lakh, 2 lakh was not paid. And we paid only 2 lakh only. And remember that point. Unpaid interest we have in the current liability. Okay. And fresh debentures we issued. Issue of debentures. How much amount? So 10 lakh we have the proceeds. That is a inflow. So 10 lakh proceeds we have inflow. And equity share capital has been increased during the year. Okay. So 250 minus 195. How much? 55 lakhs. So issue of equity shares. That is also a inflow. Okay. And these are the points we have. So 55 plus 10 minus 70 minus 5. So 10 lakhs. Okay. So net cash flows from operating activities. How much? Sorry, 70 is investing activity. So 55 plus 10 minus 5. Nothing but 60 lakh is the inflow. 60 lakhs. So here 60 lakh is the inflow and 70 lakh negative. That is cash flows from investing activity. Cash flows from operating activity 42. But here small mistakes we have. And net profit before tax is not this amount. Net profit before tax here we have. So whatever the figure we have, this is the profit before tax we have to consider. Okay. And this is about cash flow statement. And here only the new point we have is nothing but unpaid interest on debentures. That is not the new point. Just be careful about the respected point. Okay. Next, AS4. Okay. And while preparing the financial statements for the year ended 31st March 2025, P Limited has come across the following events which took place after 31st March 25. The financial statements of the company were approved by the Board of Directors on 30th May 2020. And then nothing but what? 1st April 25 to 30th May 25 is the reporting period as per AS4. Okay. And first one. And B Limited started negotiations with S Limited during the year to acquire their consumer durable business for 400 lakhs. The deal was finalized on 20th April. And here, only negotiations we started in the current year and before 31st March 2025. But the complete negotiation, the deal was finalized only on 20th April. And major terms and conditions are not accepted before the disbursement. So it is treated as non-adjusting event. Is it treated as non-adjusting event? No need to give the disclosure. No need to give the adjustment in the financial statement. Second one, during the course of the audit for the year ended 31st March, the auditor discovered a fraud of 1,25,000 done by the accountant of the company. Fraud was discovered on 20th April, but the accountant of the company had left the job and absconded on 29th of March. The fraud was discovered by the accountant while during the audit before 31st March. Before 31st March. So it is treated as a what? Adjusting event. We have to create the loss of rupees 1,25,000. Next. A fire engulfed the warehouse of B Limited on 13th April and destroyed inventory worth 15 lakh lying there. No condition we have on the balance sheet date relating to that fire accident. And the entire fire accident happened after balance sheet date only. It is a non-adjusting event. But remember, even in case of non-adjusting event, sometimes we may give the adjustment only when if it is affecting the going concern assumption of the entity, if it is required as per statutory duty, statutory as per law, if it is required as per law. So if it is assuming that if it is affecting the going concern assumption, even though it is a non-adjusting event, we have to make the adjustment in the financial statement. Okay. Otherwise, it is a non-adjusting event. No need to give the adjustment in the financial statement if it is not affecting the going concern assumption. Okay. So this is the one. And next, coming to the 10th question. And actually, this is not relating to the AS7. And tell me in the comments, so which standard is, okay? And the question belongs to which standard? On 1st April 2024, but this is one of the important question we have. Okay. On 1st April 2024, Y Limited purchased an industrial plot of land for 50 lakh for the purpose of constructing a new factory. This cost of 50 lakh included legal cost of 2 lakh 50,000 incurred for the purpose of acquisition of this plot. So generally any professional charges we paid to the lawyer for taking the consultation relating to the purchase of that asset should be capitalized. So already included. So the construction of the factory commenced on 1st May, but actually we purchased the plot on 1st April. The construction we start from 1st May. So 1st May. So Y Limited provides you with the following details of the cost incurred in relation to the above construction. And so preparing and leveling of the land 1 lakh 60 and employment cost of the construction workers per month. How many months they do the construction, based on that we have to consider purchase of the raw material and cost of relocation, and cost of relocation of the workers cannot be capitalized, cannot be capitalized. And the cost of inaugural function of the new factory on 1st January 2025, any inauguration expenses is also not required to be capitalized. And overhead cost incurred directly on the construction of the factory, this is can be capitalized. This has to be included in the construction activity. So which items? First, land cost 50 lakh, and next, leveling of the land 1.6 lakh, and employment cost, salary. So how many months actually they work? The construction of the factory was completed on 31st December. Center means we have to consider it from the 1st May onwards to 31st December. 1st May to 31st December. How many months we have? 8 months. So 58,000 into 8, 4,64,000. 4,64,000 we have to add. And raw material purchase, so 42 lakh 48,000. Okay. And overhead cost, so 50,000 into 8 months, nothing but what? 4 lakhs, nothing but what? 4 lakhs. And the total, so 50, 1.6, 4.64, 42.48 plus 4, 102.72, 102.7. Okay. And next, the production could commence on 1st February 2025. And I'm telling here, so as per AS10, as per AS10, so depreciation should be provided from the date on which asset came to available for use, not from the actual commencement of the production. So here, that asset came to available for uses on 31st December. So from this date onwards, we have to provide what? Depreciation, not from the 1st February. The overall useful life of the factory building was estimated to be 40 years from the date of completion. However, it was estimated that roof would need to be replaced 20 years after the date of completion. It means in the factory, two parts we have. One is the roof, another one is the rest. Roof is having 20 years life, and the rest is having 40 years life. And the cost of replacing the roof at current prices would be 25% of the total cost of the building. The construction of the factory were partly financed by the loan 56 lakh raised from the State Bank of India on 1st April at an interest rate of 9% per annum. From the 1st April onwards means 1st April to 31st December, because construction was over by 31st December. Total 9 months. So April, May, June, July, August, September, October, November, December. Total 9 months are there. But remember, construction started from 1st May onwards only. So for the first month, whatever the interest you paid cannot be capitalized. Interest should be capitalized only from the date on which construction activity has been started. So construction activity started from 1st May. So for 8 months only you need to capitalize it. And so during the period when the loan proceeds have been fully utilized to finance the construction, while limited earned an income of 50,000 from the temporary investment. This is required to be reduced it from borrowing cost. First, what is the borrowing cost? 56 lakhs into what is the rate of interest? 9% into 8 by 12. So 56 lakhs into 9% into 8 by 12. 3 lakh 36,000 minus 50,000 temporary investment minus 50,000. 2 lakh 86,000 is required to be what? Capitalized. Is required to be capitalized. So 2 lakh 86,000 we have to add. So net borrowing cost 2 lakh 86. Then what is the total? So 102.72 plus 2.86. 105.58. 105.58. Okay. Sorry. Next. And here, so assume that all of the net finance cost needs to be allocated to the cost of the factory, excluding the land. Interest cost to be capitalized based on the 8 months period. You are required to compute the carrying amount. Interest cost should be calculated for what? Based on the 8 months period. Carrying amount we have to calculate. Carrying amount on what date? 31st March. That means we have to provide the depreciation from 1st January to 31st March. 3 months we need to provide the depreciation. But coming to here, out of this, there are two parts: land, building. Land cost is 50 lakh. Coming to the building, roof is there and others. Roof cost is 25%, others 75%. So out of this, out of the 50 lakh, out of the total 105.58, 50 lakh is the land. The rest 55.58 is the building. So in 55.58, 25%. Think but 50.5.58, 25. 13.895 minus 55.5, 41.685. And its life is 20 years only, but its life is 40 years. Then what is the depreciation? 13.895 by 20 years, right? 13.895 by 20. That is per year depreciation. But we need the depreciation only for 3 months. So 13.895 by 20 into 3 by 12. 2.08425 08425 and 41.685 by 40 years into 3 by 12, 0.2605. And the remaining amount, this is the carrying amount, 50 lakh plus book value plus book value. This is what carrying amount of the asset. But in this problem, we have a small mistake here. And here the interest is computed for 9 months. Interest interest borrowing cost should be capitalized only for what? How many months? 8 months only. But they consider for 9 months. That is the mistake we have. And based on that, compute what is the total amount of remain. Rest of the everything is okay. And that is only the mistake we have. And this is problem relating to the AS10, not relating to AS7. Okay. And this is the problem, important problem. Just go through it once. Next. AS12 accounting for government grant. ARA Limited installed a plant and machinery costing 100 lakhs on 1st April 2023. Received government grant 40% towards its cost. So 100 lakh is the cost minus grant 40 lakhs, nothing but 60 lakh. And the grant was credited to P&L. So we reduce it from cost. The life of the plant is 5 years. So residual value is 10 lakhs. So 60 minus 10, 50. 50 by 5. 10 lakh per annum is the depreciation. Company charges depreciation on straight line method. So 10 lakh is the first year depreciation. And after 1 year, company had to refund. What is the book value? 50 lakh. The revised book value is 50 lakh. And company had to refund the grant to the extent of 25 lakhs on 1st April 2024 after completion of 1 year. So, and when the grant has been refunded. So, at the time of receiving the grant, we credited to the asset. At the time of refunding of the grant, we debited to asset. We have to add. So, revised book value is nothing but 75. The remaining useful life is 9 years. Then what is the depreciation? 75 minus 10 by 9. This is the depreciation. So we have to write the journal entries for the first 2 years. So what is the entries? First asset, when the asset purchased, asset account debited to bank, plant and machinery account debited to bank. We will write the entries for plant and machinery account debited to bank. That is the first entry. When the grant received, bank account debited to plant and machinery because grant is credited to asset. And for at the end of the first year, depreciation to plant and machinery 10 lakh. And at the beginning, then profit and loss account depreciation. At the beginning of the next year, the grant have been refunded. Asset account debited to bank 25 lakh. Then, so what is the depreciation? So here 75 minus 10 by 9. And the total depreciation per annum from the second year onward 16.25. Depreciation to plant and machinery. Okay. And this is the normal problem we have. And here AS40 amalgamation related and one of the important chapter, and we have a compulsory question from the standard in every attempt. A Limited and B Limited were amalgamated on 31st March 25 to form a new company named AB Limited. Prior to amalgamation, the balance sheets of two companies stood as under. And here the balance sheets we have. Hmm. So additional information, the authorized capital of AB Limited will be 100 lakh equity shares of 10 each, 7.5 lakh 9% redeemable preference shares of 100 each. AB Limited will issue the 4 equity shares for each equity share of A Limited, and the face value of equity share of AB Limited is 10 rupee and issue price is 25 rupee per share. So for each equity share of A Limited, how many shares are issued? 4. First of all, how many equity shares we have in A Limited? In A Limited, we have how many shares? So 8.64 lakhs. Correct? 8.64 lakhs and here 8.1 lakh. Then, so for A Limited, 8.64 lakhs into 4 into 4 into each share was issued at 25 rupee. And for B Limited, for B Limited, they're issuing 5 equity share. So 8.10 into 5. Each share issued at 25 rupee. Each share issued at 25 rupee. Then coming to the preference shares. How many preference shares are? 3.24 here, 2.16. And preference shareholders of A Limited and B Limited are issued equivalent number of 9% redeemable preference shares of rupee 100 each. AB Limited at an issue price of 200. Nothing but what? How many preference shares are there? 3.26, 2.16, 3.24, 2.16. So 3.24 into 200, 2.16 into 200. And this is what PC. Okay. And existing debenture holders are also getting the preference shares, but any amount payable to the debenture holders is not forming part of what PC. Okay. PC covers only amount agreed to pay or payable to the shareholders only, both to equity shareholders and preference shareholder. So first What is the PC here? Coming to equity shares, so 8.64 into 4 into 25. Okay, into 25. So this is the one relating to A limited, and relating to B limited, 8.10 into 5 into 25. So this is the one. And coming to preferential, 3.24 into 200 into 200. Okay, coming to the B limited, 2.16 into 200. Okay, this is what PC relating to A limited and B limited. And next, existing 8% debenture holders of both companies will get two 9% redeemable preference shares of 100 each for three debentures held by them at an issue price of 150. For three debentures held by them at an issue price of 100. First of all, how many debentures we have here? So here 0.9 lakhs and 0.48. 0.9, 0.48. And what is the provision we have? Existing 8% debenture holders of both company will get two 9% redeemable preference shares of 100 each for three debentures held by them. For three debentures held by them. And it means what? Number of debentures into, so number of debentures into 2 by 3. Okay. Number of debentures into 2 by 3. So how many debentures we have? 0.9 lakhs, nothing but 90,000 debentures into 2 by 3, 60,000. And each debenture they are paying what? Issued at what? 150 rupee per share. Each preference share issued at 150. This is the preference shares issued to a limited debenture holder. And 48,000 into 2 by 3, 32,000 into 150. And this is the total amount of preference share capital issued to the debenture holder. Okay. And next, all current assets and current liabilities of A limited, B limited taken over by A limited at book value, except inventory which is taken at 4% lesser than their book value, and a trade receivables. So, for a provision for bad and doubtful debts to be created at 5%. Okay, so this is what amalgamation in the nature of purchase. In case of amalgamation in the nature of purchase, you need to calculate difference between PC and net assets, and the difference is treated as either goodwill or capital reserve. But while calculating the net assets, you need to consider assets and net assets at agreed value and at what price they are taken by the transferee company. We have to consider here the net assets value was given, net assets, and this is compared with what? PC. This is compared with the PC. PC minus net assets. If the positive figure we have, so that is the PC minus net assets. Then we have the capital profit, negative figure, capital loss. And the difference amount is treated as net amount of thing. Okay. So purchase consideration minus net assets we have to consider. In case of amalgamation in the nature of merger, in case of positive, treated as a goodwill. In case of negative, treated as capital reserve. Okay. And prepare balance sheet of A limited, AB limited after amalgamation has been completed. And also we have to prepare notes to accounts. And just prepare the balance sheet on line by line basis. And the most important point in case of amalgamation is what is the PC. This is the first one. And PC is compared with what? Net assets. And the second one, calculation of what? Net assets. Here is the one. And in case of net assets, all current assets and current liabilities are taken at their book value, except what? Stock and trade receivable. For that, some provision has been created. Okay, remaining all are taken at book value. And coming to the 8% debentures. 8% debenture settlement will be done in terms of preferential. That is the third important adjustment. This is the new point we have. And here, the debenture for debenture holders also, AB Limited is issuing the preferential. But even though preferentials are issued, that is not forming part of the PC. Any amount agreed to pay to the debenture holders never be considered as a part of purchase consideration. That is the point. Okay. Next. And we have the theory questions relating to AS17 and AS19. Let's go through it once. Next, AS24 discontinuing operation. Arjo Limited is in the business of manufacture of passenger cars and commercial vehicle. Company is working on the strategic plan to shift from the passenger car segment over the coming 5 years. However, no specific plans have been drawn up for sale of neither the division nor of its assets. And as a part of its plans, it will reduce the production of passenger cars by 20% annually. It also plans to commence another new factory for the manufacture of commercial vehicle plus transfer of employees in a phased manner. Here also they are shifting on phase by phase. So you are required to comment if merely gradual phasing out in itself can be considered as discontinuing operation within the meaning of AS24. Answer is no. It is not treated as a discontinuing operation. So gradual phasing out of the one product is not treated as a discontinuing operation. And because these are all excluded specifically from the discontinuing operations. And it is not satisfying the definition criteria stated as per discontinuing operation also. So one of the definition criteria we have to mention is nothing but time bound. And no company strategic plan has no final approval from the board through the resolution, and there is no specific time bound activities. So, like shifting of assets and employees. Above all, the new segment, commercial vehicle production line, the new factory has not started. Okay. And second one, the necessary passes the company passes a resolution to sell the some of the assets in the passenger car division and also to transfer few other assets of the passenger car division to the new factory. Does this trigger the application of AS24? No, because just by passing the resolution we can't say they are getting the final approval, and just by passing the resolution you can't consider it as a discontinuing operation because the time framing is not mentioned. So we have to clearly mention by what time the total discontinuing operation will be completed. So the resolution is silent about the stoppage of the car segment in the definite time period. So though the sale of some of the assets, some transfer proposals were passed through a resolution to a new factory, and closure roadmap and new segment starting roadmap are missing, and hence AS24 will not be applicable. And next, would your answer to the above be different if the company resolves to sell the assets of the passenger car division in the phased out but time bounded manner? Then we can treat it as a discontinuing operation. Yes, because so if the time period was mentioned by what time that complete discontinuing operation is over, so then it is a complete plan. We have a complete plan, closing plan we have. And definite time period has been stated. And the total roadmap, closing roadmap was provided. So hence phased and time bounded program dissolved in the board clearly indicates the closure of the passenger car segment in the definite time frame and will constitute a clear roadmap, and hence this action will attract compliance of what AS24. Okay, next. This is already we have this type of question in the material also. And is 28. A publisher owns 150 magazine titles, of which 70 were purchased and 80 were self-created. And the price paid for purchased magazine title is recognized as intangible asset. The cost of creating the magazine titles and maintaining the existing titles are recognized as an expense when income. Cash inflows from the direct sales and advertising are identified. So here cash flows are identified for every magazine title, and titles are managed by the customer segment, and the level of advertising income for magazine title depends upon range of titles in the customer segment to which magazine title relates. So here cash flows relating to the every magazine title is identified independently, and advertising income also we can identify. So based on that we can treat every magazine title as a cash generating unit. You can treat separately. Every magazine title is treated as separate cash generating unit. So management has a policy to abandon old title before the end of their economic lives and replace them immediately with new titles for the same customer segment. Okay. So though here, so it is likely that individual magazine titles generate cash inflows that are largely independent one from another. That each magazine title is a separate cash generating unit. Next. This is also one of the important question we have. Galaxy Limited is in the process of finalization of its accounts for the year ended 31st March and needs your advice on the following issues in the line with provisions of AS29. Galaxy Limited is selling the cosmetic products under its brand name Angel and but is getting these products manufactured from Excel Limited. It has an understanding and foreseeable agreement with Excel Limited that if the company becomes liable for any damage claims due to injury or harm to the customer of the cosmetic products, 40% shall be reimbursed to it by the Excel Limited. And during the year 24-25, an estimated claim of 25 lakhs may be payable to the customer by the Galaxy Limited. How should Galaxy Limited account it for the claim that becomes payable? And here, if any damage occurred to the customer and the entire amount first paid by the company, then Galaxy Limited has to create provision. Out of that, how much amount will be reimbursed by the company? Nothing but reimbursement right of reimbursement. Only 40% out of 25 lakhs into 40%. 40% only reimbursed. Nothing but what? 10 lakh. It is shown on assets and it is shown on liability side. And don't set it off. Not set off each other. Net figure cannot be considered. But in case this is in case of balance sheet. But in case of profit and loss account, in case of profit and loss account, and the provision we have to create what? How much? 25. And income we can recognize. Reimbursement income we consider what? 10 lakh. And in case of P&L, you can net off under the net provision you may show 15 lakhs. Set off is allowed in case of P&L, but not allowed in case of balance sheet. Okay, in case of balance sheet, set off is not allowed. So since understanding the results in enforceable agreement, reimbursement of 10 lakhs shall be recognized as a reimbursement rate. Provision should be recognized 25. But remember, the reimbursement rate shall be treated as separate asset, shall not be offset with the provision. But in the statement of profit and loss, expense may be presented as 15 lakh after offsetting the reimbursement. So offset in case of balance sheet not allowed. In case of P&L, that is allowed. That is allowed. That is the point important. And second one, Galaxy Limited has been issued by one of its competitor for elect infringement of trademark and notice for levy of penalty of 50 lakh has been received by it. The company has appointed a law firm to defend its case for a fee of 5 lakhs. 60% of the fee has been paid in advance. 40% will be paid after completion of the case, after finalization of case. There are 70% chances that penalty may not be imposed. So 70% chances are there no need to pay the penalty. So no need to create provision. But so you appointed lawyer and so 40% fee should be paid whether you win the case or not. So provision should be created for the rest of the 40%. So nothing but what? 5 lakhs into 40% for 2 lakh. So provision for legal expenses has to be created. Already 60% advance you paid. Okay. So advance provision should be created for the rest of the amount. Nothing but 2 lakhs. Okay. Next. Here the schedule 3 financial statement data. The following is the trial balance we have. First, purchases. We have to show it under cost of purchases and wages and salary, employee benefit expenses, rent, other expenses, rates and taxes, other expenses, selling and distribution. We have to show it under other expenses, directors fee, other expenses, bad debts, other, interest on term loan, finance cost, land, PPE, so factory building PPE, plant and machinery PPE, furniture and fittings PPE, trade receivables under current assets, advance tax, short term loans and advances on asset side of the balance sheet, opening stock, in change in stock in P&L, and bank balance, cash and cash equivalent, cash on hand, cash and cash equivalent. Okay, next. Here, sales, cash flows from operations, sorry, uh, revenue from operations in income statement in P&L, commission, other income, equity share capital, general reserve, reserves and surplus. P&L is also under reserves and surplus. Security premium is under reserves and surplus. Term loan, long-term borrowings, trade payable, and one more point. So provision for depreciation. So those are required to be reduced from assets, cost of the assets under PPE. But remember, depreciation expense was not given. So you need to provide the depreciation and is added to the corresponding provision while reducing it from cost of the PPE. Provision for doubtful debts we have bills payable, nothing but trade payable. We show it under trade payable. This is the trial balance data we have. Next, coming to the additional. Authorized share capital 2 lakh equity shares of 10 each. Company issued 1 lakh equity shares of 10 each. Rent, so 20,000. Wages 1,56,500 are outstanding. This is added to the rent. So in other expense and along with that outstanding rent we have to show it under other current liabilities. And here 1,56,500 is added to the employee benefit expenses to the wages and salaries. And again outstanding wages we have to show it under other current liabilities and provide the depreciation. Okay. And closing stock we have. And this closing stock we have to show it under stock and change in stock of inventory. Make a provision for doubtful debts on 5% on debtor. And first of all, what is the trade receivables we have? So trade receivables 64 lakh 75,000 into 5%. 3 lakh 23,750. 3 lakh 23,000. How much? 5%. Make a provision for bad debts 5% on debtor. So 64 lakh 75,000 into 5%. So 3,23,750. But out of that opening provision, we have how much amount? 20,000, 25,000. So here 3,23,750 reduce it from the debtors. But coming to the P&L, in P&L, so under the other expenses, provision for bad debts, we have to show how much amount. So 3,23,750 minus what is the opening provision? Sorry, 25,000. And the remaining amount we have to show it under other expenses. Sorry, this is the 2,98,750. Okay, and next, make a provision on 25% corporate income tax we have to create and general reserve we have to transfer, reduce it from profit and loss and add it to general reserve. And installment of term loan out of the total term loan from PSI, the public sector bank, that is a long-term borrowing. But out of that, one installment payable within 1 year. This is the current maturity of long-term borrowing. We have to show it under short-term borrowings. And the remaining amount we have to show it under continue under long-term borrowings. Okay. And trade receivable. So in case of trade receivables, the disclosure should be due for more than 6 months, others. And after that, we have to reduce provision for bad and doubtful debts. And the board of directors declared a dividend 10% on what date? 5th April. 5th April means after balance sheet date. Then coming to as per AS4, it is a non-adjusting event. But disclosure should be in what? Notes to accounts. It is a non-adjusting event, but disclosure we have to provide it in notes to accounts as per AS4. So don't forget to write a note. Okay. So you require to prepare the balance sheet and profit and loss statement as per schedule 3. Okay. So this is the problem we have. And next one. This is relating to what? Schedule 3. Next. Internal reconstruction. Following is the balance sheet of Ellora Limited. Okay. Then, so here we have to write the journal entries relating to the ARC scheme. Equity share capital write down to 2 rupees each. Then what is the entry we have to write? Equity share capital, hold price, 2 equity share capital, 2 rupee. Remaining amount is transferred to capital reduction. So equity share capital account debited to equity share capital to capital reduction. And same way preference share capital. Preference share capital account debited 100 each, 2 preference share capital 75, and the rest is transferred to capital reduction 25 per share. Of the preference shares dividend, which are in arrears for 4 years, the preference shareholders have agreed to forego their claim for arrears of dividend for 3 years. 3 years arrears have to be foregone. And preference dividend arrears is an unrecorded liability, nothing but contingent liability. If any waiver we have relating to the unrecorded liability, ignore it. But the remaining preference shareholders accepted equity shares of 2 each. Then we have to write it through the capital reduction. So capital reduction account debited to equity share capital account. What is the entry? Capital reduction account debited to equity share capital. So this is what 96,000 is the 1 year dividend. And interest payable on debenture is paid in cash. Then we write the entry interest account debited to cash. Outstanding or interest payable account debited to cash. Okay. Next. The debenture holders have agreed to take over freehold property whose book value 4 lakh at value of 4 lakh 8. First of all, coming to freehold property, 4 lakh worth book value is there but has been increased to 4 lakh 80. First we write the entry. Freehold property account debited to capital reduction 80,000, and after that debentures account debited to freehold property. So 4 lakh 80,000. 4 lakh 80,000. And they provided 5 lakh 20,000 fund to the company. And again, we are getting what amount from the debenture holder, but they are receiving 9% debentures again. So bank account debited to 9% debentures for how much amount? 5 lakh 20,000. These are the three entities. So debenture holders take over one freehold property whose book value is 4 lakh at valuation of 4 lakh 80. First increase the freehold property value. Freehold property account debited to capital reduction 80,000. And next, so debenture holder account debited to freehold property. And after that, bank account debited to 9% debentures we have. And next, inventory is write down by 2 lakh 60. Any decrease in value of an assets or anything we have, will write at last. Provision for bad and doubtful debts and intangible assets and debit balance of P&L account to be written off. And the remaining freehold property after giving the debenture holders to be revalued at 15 lakh 50. First verify what is the freehold property we have. So 17 lakhs. Freehold property we have is 17 lakh. But out of that 4 lakh is over. The remaining is 13 lakh. Okay. And 13 lakh freehold property is revalued as what? 15 lakh 50. 2 lakh 50 increases there. So freehold property account debited to capital reduction 2 lakh 50,000. Non-current investment has been sold off. What is the non-current investment value? 2 lakh 20. But the 2 lakh 20 worth we sold it for 5 lakh 60. So we write the entry what? Bank account debited 5 lakh 60. To investment 2 lakh 20. And the remaining is transferred to what? Capital reduction. So 3.4 lakhs. Okay. And a contingent liability 1 lakh is payable and which has arisen due to the wrong action of one director. He has agreed to compensate the loss out of the loan given by him to the company. So one of the loan taken from the director we have one. loan taken from the director. So, so here and under other current liabilities, they showed loan from director. How much amount? 4 lakhs. Then relating to this one, we have the 1 point and one penalty we are paying, which is created because of the wrong action done by the director. So it is adjusted to loan. So loan from the director account debited to loan from the director account debited to provision for contingent liability. How much amount? 1 lakh. And another thing, for the remaining balance, out of the 4 lakh, 1 lakh was adjusted. Remaining 3 lakh is there. So remaining 3 lakh is there. Director have agreed to take the cash payment of 20,000 and allotted 1,30,000 equity share. So loan from the director. So 3 lakh. Two cash, two equity share capital. So 1,30,000 into 2, 2,60,000. And the remaining nothing was stated. That is transferred to what? Capital reduction 20,000. Capital reduction is how much? 20,000. Okay. So these are the 2 points. Okay. Loan from director account debited to provision for contingent liability. Loan from director to equity share capital to bank to capital reduction. Next. There is a capital commitment of 10 lakh. Contract is cancelled on payment of 5%. Then it is also unrecorded liability. We have to create it through capital reduction. So capital reduction account debited to bank. Sorry, provision we have to create. How much amount? 5%. 10 lakh into 5%. For 50,000 we have to create. Company issued 2 lakh new equity shares of 2 each check for payable in full amount. Bank account debited to equity share application account and equity share application account debited to equity share capital account. And there was issue was underwritten. Commission was 5%. Actual what is the entry? Underwriting commission account debited to bank. Profit and loss account debited underwriting commission. But here underwriting commission is not transferred to P&L because it is done as a part of the scheme. So it is also transferred to capital reduction. So we write the entry capital reduction account debited to bank for commission 5% into 4 lakhs. Next, tax liability settled at 3 lakhs. What is the tax liability we have? Provision for tax liability. So 4 lakhs. And that is settled at 3 lakhs. That is paid at what? 3 lakhs. So provision for tax. Oh, then what is the entry we have to write? Provision for tax account debited 3 lakh. And the remaining capital reduction, sorry, provision for tax account debited to what? 3 lakh. So to bank 3 lakh. We paid 3 lakh. But the remaining provision, 1 lakh, is transferred to capital reduction. So you may write combined entry. Provision for tax account debited 4 lakhs, to bank 3 lakh, to capital reduction 1. And reconstruction expenses. Capital reduction account debited to cash 15,000. And after that, after completion of all entries, capital reduction account debited to inventory. So two provision for bad debts, two goodwill, two patents and trademark, two profit and loss account. If any balance we have transferred to capital reserve. And this is the capital reduction account we have to get. And the difference amount ultimately we transferred to capital. So, okay, next. And this is relating to foreign branch. Following is the trial balance as on 31st December of the Cambridge branch of Harry Limited, whose head office is situated at Pune, India. And here is the trial. Then first verify the question. So prepare the branch trading and profit and loss account in euros. You have to prepare it what in euros. So two opening stock. What is the opening stock we have? 36,000 and goods received from head office. And here, how much amount? 12,000. And sales, 2 lakh 80,000 we have. Sales 2 lakh 80,000. And closing stock. What is the closing stock we have? Hmm. So here only opening stock was given and closing stock was not given. So here we have the furniture, stock, debtor, cash at bank, head office, creditor, sales expenses, goods sent from head office. Okay. And in the books, the branch account stood. So Cambridge branch account. And goods entered to the branch at cost plus 10%. And branch sell the goods at invoice plus 25%. And so like the cost is 100. Then loading is 10. And what is the invoice price? They are sending it 110. This is what. And here we have the sales. What is the sales we have? So sales 2 lakh 80,000. 2 lakh 80,000. Then what is the cost of goods sold? So 2 lakh 80,000 into 100 by 110. We have 2 lakh 80,000 into 100 by 110. So then we get what? Cost of goods sold. Okay. Cost of goods sold. Okay. Sorry. Sorry. This is the invoice price. Then what is invoice price is 110. Then what is the profit? Brand selling the goods at 25%. So invoice price plus 25%. So nothing but 110 into 0.25. 27.5. 137.5 rupees. Then 137.5. And here branch is selling the goods at what? Invoice price plus 25%. Actually, goods sent to the branch at cost plus 10%. The cost is 100, then loading is 10, then invoice price is 110. And the branch selling the goods at invoice price plus 25%. Invoice price is 110 and the price is 27.5 and so sale price is 137. Then cost of goods sold equal to so 2 lakh 80,000 into 110 by 137.5. Okay. Then we get what? Cost of goods sold. Cost of goods sold formula is what? Opening stock plus purchases minus closing stock. And from that we can compute what is the closing stock. So here we computed the closing stock is how much? 37. Opening stock plus goods received from head office. That is only the purchase. From that we have to reduce the cost of goods sold. Remember at invoice price we have to calculate at invoice price. So what is the amount we have here? So 2 lakh 80,000 into 110 by 137.5. 2 lakh 24,000. So 2 lakh 24,000. So what is the closing stock we have? 37,000. And the 37,000 closing stock we considered here. Then we have the gross profit. And from this, expenses are provided. What is the amount of expense? Here we didn't have. So here, sorry, expense is 12,000. Expense is 12,000 and goods sent from head office is 2 lakh 25,000. Goods sent from head office is 2 lakh 25. Expense is what? 12,000. And we need to provide what? Depreciation. And one more point we have, nothing but managerial commission. So furniture acquired on 1st April, you need to provide the depreciation at what? 10%. So total furniture we have 80,000. So depreciation is 8,000. And another point is the branch manager is entitled to get commission on the profit before charging such commission. Then first calculate what is the profit here, gross profit. So here 2,80,000 plus 37,000 minus 36,000 minus 2,25,000. Nothing but 56,000 is the gross profit. So 56,000 minus 12,000 is the expense minus 8,000, 36,000. So managerial commission 36,000 into 10%, 3,600, and the remaining is the net profit. Because managerial commission we need to provide before charging such commission. Before charging such commission. So what is the net profit we have? So net profit here is nothing but 36,000 minus 3,600. 32,400 is the net profit we have. Okay. So net profit is here how much? 32,400. And you need one more point, one more question we have. Convert the trial balance into Indian rupee. We have to convert. While converting the trial balance, furniture is converted at what? Actual rate. And opening stock is at opening rate. Debtors is at closing rate because it is a monetary item. Cash at bank at closing rate. Head office actual figure we have to consider, and creditor is at closing rate, and sales is at average rate. Sales revenue items are at average rate, monetary items at closing rate, opening stock at opening rate, PPE at actual rate, means rate of exchange available on the date of transaction. But head office account goods received from head office, these are all actual figures we have to consider. Expenses is at average rate. This is also we have to consider actual figure. And here we have, and this is what? Integral foreign operation, because nothing was stated about this. So the difference amount, if any, we transfer to what? Profit and loss. And here is the one. So this is the calculation of managerial manager commission. Okay. So this is about all questions we have. We completed all questions in RTP, and we have few important points. Some mistakes also we have in this RTP. And one is here some expenses amount was not printed. So expenses amount, goods sent from head office was not printed. And another one in AS 10 question. So actual AS 10 question, borrowing cost is required to be capitalized only for 8 months, but they consider it for 9 months. That is the mistake we have. Okay. So go through it, and if better, so please do practice of all questions once, and some theory questions also. Just go through it. Maybe we have a chance of getting the theory question in the last question for 4 to 5 marks. Okay. So hope you enjoy the video. If you are new to my channel, please subscribe it and like it. And if you have any doubt, then so comment in the comment box. Okay. Thank you. Take care. Bye bye.